in business combinations, the first step we have to do is to do a acquisition analysis to calculate the fair value of the net assets assumed by the acquirer, in order to compare that to the consideration that was transferred, to see whether any goodwill resulted from this business combination that needs to be recorded in the books of the acquirer. In this example, I just want to look at the concept of net asset value. Now, I've got on the screen just a simple summary of assets, liabilities, and equity of a company, split into the assets and then another section, the liabilities and equity. So similar to what we'll find in a balance sheet or a statement of financial position. So if you just focus on the first column now, the carrying amount, so that is the amounts that will be included in the financial statements of the company. Net asset value is then calculated as what is left of the assets after the liabilities have been covered. Now, if we just think in terms of a balance sheet, we'll be able to say that our assets equals our liabilities added to that our equity. So equity plus liabilities equal assets. So if we just turn that around, it says that equity is the same as assets less liabilities, and that is our net asset value. So the assets that are left after the liabilities have been covered, and that is theoretically what the owners of the company, it represents their share in the company, because it is similar to the equity figure. So in this example, our net asset value would be calculated as $664,000. That's our total assets, less our liabilities. That amounts to $90,000. Therefore, our net asset value at carrying amount should be 574,000, which should agree to our total equity. Now, the reason why you should understand this concept is that in our acquisition analysis, we have to calculate the fair value of the net assets that have been acquired by the company that did the business acquisition. And in some questions, you will be given sufficient information to calculate the fair value of the assets and the liabilities. But in other questions, you might only receive information on the fair value of the assets that has been acquired, together with maybe information on the equity of the company that is being acquired. And then you need to be able to, from the equity figure, calculate the net asset value at fair value of the assets and the liabilities, the assets acquired and the liabilities assumed. Now let's first calculate the net asset value at fair value using the information presented in the table. So we've got different assets, and for this question assume that the plant and equipment and the land, the inventory and the accounts receivable is acquired by the company, and the loan is also taken over by the acquirer. The motor vehicles is not part of the business combination transaction. The cash is withheld in the company that's being acquired, and they also receive sufficient cash from the acquirer so that they can settle their accounts payable. So let's just get rid of all of these and then calculate the net asset value at fair value. So if we looked what assets are being acquired, first of all, our plant and equipment. So the fair value of our plant and equipment is it's $307,000. Our land, the fair value is $257,000. Our inventory is $30,000, and our accounts payable, maybe just get that better in line. 257, 30,000, and our accounts receivable is 16,000, and then the loan that we assume is 55. So that gives us a net asset value at fair value of $555,000. Okay, so this is the amount that we'll then compare to the consideration that is transferred to see whether any goodwill exists from this transaction, or whether it was a bargain purchase, the result of this business combination. Okay, so that is the approach if you've got sufficient information to actually value each of these, the assets and the liability items, to measure it at fair value. But what do you do if you don't have all the information? Your starting point will then be your retained earnings. Just clear the screen quickly. So your starting point will then be your retained earnings at carrying amount. So the retained earnings, the equity, the carrying amount of the equity, so the information that will be presented in the financial statements. So that would be our starting point. And that's a total of $574,000, and that is our similar as our net value at carrying amount. So the net asset value as presented in the financial statements. What adjustments are then required to calculate from that figure the net asset value at fair value? Now, first of all, we have to make an adjustment then for fair value adjustments. So we need to look at the difference between the fair values and the carrying amounts of the asset items. So our plant and equipment, there's a difference of $3,000. The fair value is less than the carrying amount. For the land, there's similarly a $3,000 difference where the fair value is less. Our inventory, the fair value is $6,000 more, and our accounts receivable is $2,000 less. So the net effect of that in terms of our fair value adjustments is a downwards adjustment of $2,000. Then we also have to exclude the items that are not acquired or taken over by the company that's doing the acquisition. So in this example, it would be our motor vehicles, cash, and accounts payable. So the net effect of that is a $17,000 adjustment, and that is you can call that items not acquired. Okay, so if we do the calculation then and make the adjustments, we'll get to our net asset value at fair value, which was the same as that we've calculated in the first calculation. Now in this example it might look simple to or strange to do this alternative calculation, but I just wanted to illustrate to you what our net asset value at fair value actually consists of and where it originates from, so that when you are presented in an example with a situation where you don't have all the information to calculate the net asset value at fair value just based on revaluing the items acquired, that you then understand that you can start from your retained earnings and share capital, so your equity figure, and that equity figure is the same as the net asset value at carrying amounts, but then you need to make the two adjustments, the adjustment for any fair value differences and then also the adjustment for any items that were not acquired as part of the business acquisition transaction. Okay, I hope that clarifies that, because you'll see examples like this when we start doing consolidations, and then you might not understand why they start off with our equity figure. But after this example, I'm sure you'll be fine with the whole concept. If you need any further explanation, please feel free to post a question on My Guru. We'll be able to maybe deal with it in more detail.